I think that corporate earnings are definitely going to continue to come in. And, I think there is going to be ultimately some kind of a tax cut, Martin. But I just think that given the disconnect between the stock and the bond market is a little bit more realistic in terms of the future. You've got stocks up some 13%, and it just seems that with all of the uncertainty that is out there from a geopolitical standpoint, from a regulatory standpoint, that being up 13%, something just seems wrong with this picture to me. You've got bonds, on the other hand, are up, in the mid-single digits, and it just feels better to me.
I mean, you're not the first person to tell us that the bond market is probably reading things better than, let's say, equities. But with the 10-year at about 230, so starting to price in a little bit tighter money, I get that. But wouldn't you say that over the long term, there's probably more downside for bonds and upside for stocks as rates continue rising?
I would say that for treasuries, Martin, but I have to tell you, I really, when I talk about bonds, I think there are continue to be interesting opportunities in corporate bonds, both investment grade rated issues and below investment grade issues, and even many emerging market issuers. It's a much smoother path, and on a risk-adjusted basis, makes a lot of sense. So, it's treasuries. I think you've got to have a place in your portfolio for treasuries. It's that insurance policy for these risk-off periods that we get. So you need to have treasuries in your portfolio. But when I say bonds, it's really corporate bonds, some emerging market issuers that still have very attractive yields, particularly in a world where a quarter to a third of the world still offers negative yields.